So I thought it would be fun to take a little trip down memory lane and look at some of my financial models that I created when I was an investment banker. There are 3 of them here, and you can see that all of them are over 15 years old. Hopefully they actually open. Yeah, so I had built-in macros. And then here, summary with synergies. So this was an M&A model. And then standalone DCF. You can see here the CAPM. Synergy, so this was the M&A model. Now, you barely ever use DCF. You never use it as a primary means of valuation. You're always going to use comps. Man, I completely do not understand this stuff now. I forgot so much. Here's the CapEx and the DNA schedule. This is when I was working at Petsky Prunier, when we worked with Dynamics Direct. For this one, they just had me build the financial model. Incremental Alturian. So what they do is anything that is in blue, that means that it's an input. If I were to change this to 50%, then it would automatically update the model. So these are the assumptions. Partner fee would increase by, your assumption would be 25,000, but then let's say I increased it to 30,000, right? Then all the numbers would change. It would flow through, or at least it's supposed to. I mean, this model is over 15 years old, so I'm not sure if everything is still linked up. Let me see, indirect model, projected revenue, increase it to 30%. Yeah, so you see what I did here? The indirect model, you increase it. Previously, it was 25%. Then you increase it to 30%, and then everything flows through. So here are the synergies based upon the M&A transactions, as far as like duplications. So this wasn't a financial sponsor, it was a strategic acquisition. And then let's say you would assume 30% synergies, then it would obviously increase the overall net income for the entire deal. Okay. And then let's see. Man. Personnel, total expense. It looks like these came from the company. And this is the problem. As a banker, you would get the documents directly from the CFO. And yeah, the CFO is a certified public accountant. They have all the necessary qualifications and certifications. But at this time, I was like a 25-year-old kid, and I had to take their internal financial statements and then convert them to what a strategic or an investment banker or a private equity firm would use for valuation purposes. Total revenue. I really want to show you the other model because that one I'm actually much, much more proud of. So give me 1 second. I think the other model is for Vacation Connections. It's this model. All right, so I'm pretty sure that this is for Vacation Connections. And I'm pretty sure, if I remember correctly, we sold Vacation Connections to the Cypress Group. All right, let's go through this. Look, there's 130 sheets in this financial model. Okay, so let's see. There's 130 sheets here. This model probably took me, I'd say about a month to put together. And then, I had to label all the tabs. Now, when you're an investment banker, the most important thing is to be organized. So I would put all my questions and then I would delete them when they were no longer questions. So the only question that I had right here, number 7 in line 30, the 25,000 is inconsistent with the add backs and needs to change. I zoomed in. Yep, this is for Vacation Connections. And then here we have the actual. And then here we have the LTM, which stands for the last 12 months. Then you can see the cost of sales, the operating expenses, the EBITDA. The reason why you use EBITDA is because EBITDA is basically operating income, but it neutralizes the capitalization structure of the company. So you're taking out the depreciation and the amortization, and you're also taking out the interest expense that you would pay on debt and the taxes. And then also you're adjusting for any non-recurring items. So here's the net income. And then here, the reason why there's a red mark here is probably because I added like a note, but this was done in Excel. And right now I'm using LibreOffice, so I have no idea how to read that note. So here are the adjustments. Here's the adjusted LTM EBITDA. All right, let's go through this real quick. We're obviously not going to go through all 130 pages. I'm actually really happy that it opened up. I haven't looked at this in over 15 years, and I forgot so much over the past 15 years. So here, what Vacation Connections would do is they would approach brands and then put together those like goodie bags or those party bags. And then the brands would pay Vacation Connections in order to be in the bag that you would receive if you went on a cruise. So let's say you went on a cruise or you stayed at a hotel, then you would be given free samples. And then the company would actually pay for that right in order to give their product away for free with the expectation. And obviously it worked because these companies wouldn't spend millions of dollars if they didn't see a return on their investment. But the companies hoped that the passengers or the people who stayed at the hotels would associate the positive memories that they had on vacation with their product. And then when they got home, they would then purchase those products. So you can see that Vacation Connections, their biggest client was actually Carnival Cruise Line. So they generated around $3.5 million from Carnival, then event marketing, NASCAR, Orlando, Pinpoint Golf, resorts, etc. Then the cost of sales. This was actually a very, very profitable business. So their EBITDA margins, or for all intents and purposes, their profit margins were about 44% pre-tax, and without depreciation and amortization, and also without the interest expense. But obviously they didn't really have much debt, and they also didn't have much depreciation and amortization or assets on their balance sheet because the net income was very close to the actual EBITDA number. So this is a highly, highly lucrative business, and it also is not asset heavy. So they also had Keyplan. So Keyplan was not as profitable as the main business, but it was still pretty profitable. And this had something to do with ski resorts. I don't remember exactly what it was. Then revenue by program. So here you can see their Carnival. And here we're actually projecting a significant increase in the revenue from Keyplan. And then here's the SG&A, like the overhead expenses. This is a real financial model for a company. I think it ended up selling for about like $35–40 million, which nowadays is probably about 60 to 65 million. It's not a huge transaction. I've done transactions that are more than 20 times larger, but it's still nice to go through the financial model and then look at everything. I'll try to wrap this up soon. Here we have the P&L old. The revenue by channel. Yeah, so sampling generated the majority of the revenue. Then media. Marriott. Yeah, so look at this. They had close to 100 million samples that they gave out. All right, let me fly through the rest of it. Yeah, so this looks like it's something provided from the company. I remember this model because it was 130 tabs. It used to crash my computer. This was back in like 2006, I believe. And here are all their customers. Yeah, summary revenue by client. So when you're purchasing a company, you want to make sure that there's not too much concentration of revenue in one customer, because that customer is going to have too much power. And then also it's a giant risk. If you have too much revenue concentration, then it's going to put the business in jeopardy. So here, Vacation Connection. So it looks like Procter & Gamble was their biggest client by about 3 times. That's pretty sizable. I mean, Procter & Gamble by itself represented about 1/3 of its revenue. So I'm sure that during the due diligence phase, the acquirer would speak to Procter & Gamble, and they would make sure that all the contracts were going to be renewed, etc. All right, let's see. The VC consolidated. These add backs, these are for the non-recurring items. All right, so you'd have maintenance, the ADT, monthly LTM calculations for Cypress, automobile leases for his personal leases, one-time legal fees. So these are something that you call adjustments, right? These are the adjustments that you make to the EBITDA number. And it's sizable because here you have $247,000. And then if you apply like a 7x or 8x multiple, then you could be looking at almost $2 million. And then here we have the depreciation and CapEx schedule, which there's not going to be that much CapEx or depreciation because they don't have that much assets. Their products are actually given to them. Yeah, you can see that their biggest PP&E is for the display advertising equipment. I think that's more so for the key plan for the mountain and then automobiles. And then I think that's it. So let's just end it here. But it's kind of like a trip down memory lane. You know, let me just quickly go through everything. And that's it. All right. So I hope you enjoyed this. I know it might look like a lot of numbers, but this is basically what we did. This is work as an investment banker, and you want to make sure that the numbers are as accurate as possible. You find buyers, you run an auction, you do diligence, you receive bids, letters of intent, they're called LOIs. And then, well, first you receive indications of interest, then you receive letters of intent. The interested parties sign NDAs, which are non-disclosure agreements. And then you basically just continue on with the auction and see who provides the best terms.